your initial thoughts.
Good morning. Yeah, so actually the direction of the CPI and PPI is broadly in line with what we have been looking for. So we were looking for CPI at 2.9%, and then PPI at 4.3. So it's broadly in line. I guess if you look back to the first half of the year, China's inflation situation has been quite different from the rest of the world in that we have actually quite subdued CPI inflation, while the rest of the world has been struggling with very high and rising CPI inflation. But then on the PPI side, we do suffer from high PPI inflation because of commodity prices. So the thing is that going forward, we do see that trend to somewhat reverse into the second half of the year, in the sense that CPI inflation would pick up. We are looking for about 3% or slightly more for the second half of the year. That's partly on the back of pork prices, as you mentioned earlier on, which has been bottoming after coming down steadily since the early last year, and then would likely gradually recover. Perhaps also interesting is on the core CPI side, as in core CPI has generally been pretty subdued at below 1% so far this year, which has been reflecting the relative lagging on domestic demand side. So going forward, we do look for some moderate recovery in domestic demand, and core CPI would probably trend up somewhat as well.
We're getting more details on that very point. July food prices are up 6.3%. I mean, inflation hits differently. In the US, you have a relatively strong economy. I mean, 8.5%, you might not feel that. But in China, of course, the economy, to your point, is not as strong. Have you seen any evidence at all that even inflation at 3% is changing the way people buy things?
Yeah, I think in China, typically, we focus on headline CPI, which is what the central bank as well as the general households focus on. And yeah, surely food prices is an important component of people's purchasing basket and therefore their sense of the inflation situation. So in that regard, to some extent, the trend of still moderate but a gradual rise in headline CPI would likely pose some restraint on the room of monetary policy going into the second half of the year, which is why we do expect the PBOC to be cautious on the interest rate front and hold steady on the policy rate.
Okay, the elephant in the room, just away from inflation, is property. What do you think? What's going to happen? It's a problem.
Yeah, indeed, the property sector is a key risk that we see for the Chinese economy, not only in the near term, but also in the longer term. So we do have done some fundamental analysis on China's housing market. So the way we see it is that China's housing demand growth has already peaked about 4 to 5 years ago. And so that is because of aging population, decline in birth rate, slower rate of urbanization, as well as higher level of household leverage. So what that means is that in the coming years, housing demand is going to gradually slow. And in that process, if that is not managed properly, you could see near-term hiccups such as the mortgage repayment suspension request that we have seen in recent weeks, which could pose macro and financial system risk overall, as in a real estate sector not only affects the property market and real estate investment, but also households' wealth, financial risk, as well as local government financing. So the way we see it going forward is that the central government would quite likely work on together with the local government to contain the spillover of the mortgage suspension requirement. But then we do think that it will be quite difficult in the short term to come up with a comprehensive solution to address the problem. What that means is that going forward, housing market will continue to be somewhat of a drag on overall growth, and it will be very difficult for it to come back as a major driver of growth as we have been used to in the past 10, 20 years.
Yeah, about a third of total output, right, is the general understanding there. That takes us into next week. The activity numbers are coming out on Monday, including property investment that's coming out. Just give us a preview. What are you watching among this very long list, including, by the way, credit data, which should be out any day now?
Yeah. The way we see the growth picture is like this, as in we have a growth forecast of 3.2% for the overall economy for the full year. But then if you look at the near-term sequential momentum in the economy actually contracted about 8.7% on a quarter-on-quarter annualized basis in the second quarter because of the Omicron-related lockdown measures and so on. So going into the third quarter, we are looking for some decent recovery. So we are looking for about 10% plus on a quarter-on-quarter basis because of the opening of the economy and also the government's support measures. So for instance, we are looking for infrastructure investment to show double-digit growth, while real estate investment will be slowing down. So third quarter growth would probably be okay. That should be reflected in the July number. But what we are more concerned is going into the fourth quarter when the support from fiscal side is going to fade. And then at the same time, you have the lingering drag coming from real estate sector. And on top of that, global demand would likely slow. So we are more concerned on the fourth quarter and year-end growth numbers going forward.
All right, 3 seconds or so, what's your full year growth target?
We do think that the government has de facto left the target, but what they are saying is that we should arrange for a reasonable growth, basically focusing on stable labor market, stable inflation.
What's your forecast?
Our forecast is looking for 3.2% growth for the full year.